The Risk Management Agency has two products that can help producers manage their financial risk as it pertains to livestock. The Livestock Gross Margin Program takes into account two variables, livestock prices and feed cost. The Livestock Risk Protection Program takes into account one variable, market prices. Each producer has different attributes, and it is important for producers to understand the difference in order to make the right decision when trying to decide how to best manage risk. While producers can lock in prices through the futures market, using the futures market requires a contract for a sizable number of animals or pounds. Both LRP and LEGM offer price protection on any number of animals. It is important to note that while these programs cover producers from falling livestock prices, rising feed costs, or both, neither of these programs protect producers against disease or death losses. LGM can be purchased for cattle, dairy cattle, and swine. As stated in the previous slide, LGM is based on two variables, the market value of the livestock and feed cost. The formula to remember for this program is gross margin equals the market value of the livestock minus feed cost. Producers receive a loss payment if there is a difference between the gross margin guarantee that is established at the time of purchasing the insurance and the actual gross margin. Futures prices are used to determine the expected gross margin and the actual gross margin. Prices are based on simple averages of futures contract daily settlement prices and are not based on the actual price a producer may receive at a local market. Producers can tailor LGM to ensure the number of head, or in the case of dairy, the hundredweight of milk, to match the actual size of their operation with certain limits. For cattle, producers can insure up to 5,000 head during any 11-month insurance period and up to 10,000 head per insurance year. For dairy cattle, producers can insure up to 240,000 hundredweight of milk during any 11-month insurance period or year. For swine, producers can insure up to 15,000 head during any 6-month insurance period and up to 30,000 head per insurance year. As with any insurance product, a producer needs to consider what deductible is most appropriate for their own situation. The deductible is the portion of the expected gross margin a producer will not insure. Deductible amounts that can be selected for cattle is $0 to $150 per head in $10 increments. Deductible amounts for dairy cattle can be selected between $0 to $2 per hundredweight in 10-cent increments. For swine, a deductible can be selected from $0 to $20 per head in $2 increments. LGM products are sold on the last business Friday of each month. For LGM cattle, the premium is due with the application. For LGM dairy cattle and swine, the premium is due at the end of the insurance period. An important component for producers to understand when considering LGM is the insurance period. For cattle and dairy, the insurance period includes the 11 months following the sale's closing date. For example, the insurance period for the January 29th sales closing date contains the months of February through December, with the coverage beginning the second month of the insurance period. In this example, coverage would be March through December. For swine, the insurance period is the 6 months following the sales closing date, with coverage beginning the second month. Cattle producers need to be aware that there are two different types of LGM endorsements, and their selection should be based on the type of cattle included in their own operation. One endorsement is finishing yearlings. This endorsement is designed for 750-pound feeder cattle to be finished to 1,250 pounds and uses a fixed corn amount of 50 bushels. The other endorsement is finishing calves. This endorsement is designed for 550-pound feeder cattle to be finished to 1,150 pounds and uses a fixed corn amount of 52 bushels. Again, producers should remember LGM cattle does not insure against death, loss, or any other loss or damage to the producer's cattle. Walking through an example can help producers have a better understanding of how the program works. In this example, the producer is looking at the yearling finishing endorsement, which is designed for 750-pound feeder cattle to be finished to 1,250 pounds and uses a fixed corn amount of 50 bushels. This producer purchases an LGM policy September of 2015 and wants to provide coverage for 100 head that will be marketed in March of 2016. In this situation, the insurance period begins October 2015 and goes through August 2016, with coverage beginning in November 2015. The producer selected a $10 per head deductible and pays a premium of $85 per head. The expected gross margin is based on the futures market and can be found on the RMA website. In this case, the expected gross margin is $130.80 per head. While the RMA website does the calculation for the producer, it is important the producer understand what is included in the calculation. The formula for the calculation can be seen at the bottom of the slide. Expected gross margin equals 12.5, with the 12.5 representing the finished weight of 1,250 pounds, times the futures price of live cattle minus 7.5, with 7.5 representing 750 pound beginning weight, times the futures price of feeder cattle minus 50 bushel corn times the futures corn price. Moving forward with the same example, in March the producer markets 100 head. The producer will provide a marketing report to the insurance company. At that time, RMA will calculate the actual gross margin, which is posted on the RMA website. In this situation, the actual gross margin is calculated as $7.43 a head, and the producer will be entitled to an indemnity calculated as shown below. Indemnity per head equals the expected gross margin of $130.80 minus the deductible selected by the producer of $10 minus the actual gross margin of $7.43. Totaling an indemnity of $113.37 per head. Of course, when producers are calculating their risk, the cost of the premium must be considered. In this example, the producer had 100 head and will receive an indemnity of $11,300. However, the cost of the premium was $85 per head, for a total of $8,500, leaving a net gain of $2,800 or $28 per head. LGM is available to producers in the areas of the country shown in green. Operations that are covered by LGM swine are farrow to finish operations, feeder pig finishing operations, and segregated early weaned operations. Again, LGM for swine does not insure against death or any other loss or damage to the producer's swine. LGM for swine is available in the 48 contiguous states to all swine producers. LGM for dairy cattle provides protection when feed costs rise or milk prices drop. Again, just as with cattle and swine, the program can be tailored to any size farm. The formula for gross margin for dairy equals the market value of milk minus feed cost. LGM Dairy uses futures prices for corn, soybean meal, and milk to determine the expected gross margin and the actual gross margin. LGM Dairy is similar to buying both a call option to limit higher feed costs and a put option to set a floor on milk prices. It is again important to note what LGM for Dairy does not include. LGM for Dairy does not insure against dairy cattle death, unexpected decreases in milk production, unexpected increases in feed use, anticipated or multiple year declines in milk prices, or anticipated or multiple year increases in feed cost. LGM dairy is available to any producer who owns dairy cattle in the 48 contiguous states. It is important to note that producers enrolled in the Farm Service Agency Margin Protection Program for dairy are prohibited by law from participating in the LGM dairy program at this time. As previously mentioned, another option for producers to consider is the Livestock Risk Protection Program. LRP covers fed cattle, feeder cattle, swine, and lambs. LRP insurance plans are designed to insure against declining market prices of livestock. Producers may select from a variety of coverage levels and insurance periods that match the time their livestock would normally be marketed. Producers may choose coverage prices ranging from 70 to 100% of the expected ending value of the livestock. Lamb coverage can range from 80 to 95%. At the end of the insurance period, if the actual ending value is below the coverage price, a producer will be paid an indemnity for the difference. For the LRP program, a producer will submit a one-time application for LRP. After the application is accepted, the producer can buy a specific coverage endorsement throughout the year. Coverage prices, rates, and actual ending values are posted on RMA's website. A livestock crop year is July 1 through June 30. The crop year is used only for tracking a maximum head per year. This chart shows the maximum number of head for each special coverage endorsement, as well as the maximum number of head per year. The length of coverage is different for each type of livestock, as shown in the chart. There are several key advantages that producers may want to take into consideration when deciding whether or not to purchase LRP. First, it is important to remember there's no minimum limit to the number of livestock per endorsement, so LRP coverage is good for smaller herds lacking quantities to effectively use futures and options contracts to hedge price risk. Second, LRP includes a federal subsidy. Depending on what the market is doing, LRP can be less expensive at certain times in the market than the Chicago Mercantile Exchange futures or options because the program is subsidized 13%. LRP is available as shown in the green areas of the map. Producers that are looking to protect cattle need to consider the coverage that best fits their operation. Coverage for fed cattle is available for both heifers and steers weighing between 1,000 and 1,400 pounds that will be marketed for slaughter near the end of the insurance period. Coverage for feeder cattle is available for calves, steers, heifers, predominantly Brahman cattle, and predominantly dairy cattle. Producers can select from two weight ranges, under 600 pounds or 600 to 900 pounds. Walking through a feeder cattle example will help explain the program. In September 2015, an Oklahoma producer buys a specific coverage endorsement for 100 head of 5.5 hundredweight feeder steers for 17 weeks. The producer can find the needed information in regard to the coverage listed on the RMA website. The website shows that the expected ending value is $193.28 per hundredweight. The coverage price is $191.41 per hundredweight. The coverage level is 99% and the rate is 0.048032. Moving forward with the same example, the producer can calculate the specific coverage endorsement insured value, which equals the 100 head times the 5.5 hundredweight times the expected ending value, which in this case totals $106,304. The premium in this example equals the insured value of $106,304 times the rate of 0.048032 minus the 13% subsidy. The premium in this example equals the insured value of $106,304 times the rate of 0.048032 minus the 13% subsidy, which equals $4,442 or $44.42 per head. At the end of the insurance period, the RMA website will post the actual end value. In this example, the end value equals $174.28. Once the end value is established, the producer will know if an indemnity is payable. Again, using the same example, the producer insured 100 head of feeder cattle at an insured value of $106,304. The premium paid by the producer equaled $4,442 or $44.42 per head. At the end of the insurance period, the actual end value of the feeder cattle was $95,854, which is $10,450 lower than the insured value of $106,304. Therefore, an indemnity of $10,454 or $104.50 per head is due to the producer. Taking the premium into account, the producer in this example has a net indemnity of $6,008 or $60.08 per head. There are several useful links for producers on the RMA website. On the left column, producers can click on the livestock policies to get detailed information about the programs discussed in this presentation, as well as coverage prices, rates, and actuarial ending values. The link also includes more detailed reference material. In the center, under Quick Links, a producer can use the Agent Company Locator to search for a local insurance agent. In addition, on the right, under the RMA Priorities, producers can find helpful fact sheets for livestock products as well as other programs.